Hey there traders, how's it going? Today I've put on the video to use this opportunity to walk you through a bearish price action setup that I've taken on the daily chart. This is the Euro New Zealand dollar cross pair market. Now on with the trade, as you can see, I've already placed my order this morning. It's currently the Asian session. These are New York close candles, so the daily candle here closed at the New York close. So I've gotten up this morning and seen this setup and basically just set up my order, but I'll explain the trade first. Recently we've seen the market just shoot up with an aggressive rally that spanned across about 2 weeks there, and it's been so aggressive that we haven't seen any bearish closes throughout that rally there. It's just been, market's just fired straight up. Now we've just recently stalled in this area here. Okay, the momentum's just stopped, and one of the main things on the chart that's brought my attention here is the gap that's been caused from the acceleration, or the harsh acceleration of price away from the mean value here. Now the mean value is mapped out on our charts by using the 20 EMA and the 10 EMA, and this basically just maps out the area on the chart where the price finds value. So where the market thinks, I guess, the area where the market thinks it's a fair price. And basically when you get these accelerations away from the mean value and price starts trading at these extreme prices with this gap here, you can think of that as these extreme prices is where the market considers the price too expensive, or if like down here, if the price gap's down too far away from the mean value on the opposite side, the price is considered too cheap, on the flip side there. So using that analogy, price is considered too expensive up here, and we've got that gap. And usually I tell the other traders to consider the mean value and price to have magnetic properties. So if you put a big magnet here and a big magnet on price there, they'd be pulling themselves towards each other and being like an attraction force between the two. And that's generally how the market behaves with the mean value. It generally likes to sit very close to the price sits very close to the mean value and sort of hugs it. But when you get that gap, the attraction force becomes much greater, and that's when we start to anticipate that there's going to be a correction back to the mean after you get these gaps. Now we're trading at these extreme prices. We're anticipating that correction back to the mean at least. Now two candles here have got upper wicks, which suggests that moves into higher prices were rejected again and here again. So we've had it happen twice. The second day we've actually had a bearish signal, the bearish rejection candle signal, with a long upper tail there, demonstrating that the upper prices were rejected, and price actually closed lower than it's open. So we got a nice bearish close there. Alright, so basically they're the reasons for taking this trade. Okay, this is called a mean reversion trade. We've got the bearish rejection happening here. We've got extreme prices and the gap from the mean. So built up a few reasons there why we're considering a short position, because we've built a good case here. We're anticipating very strong correction, and sometimes these corrections can be so strong that this support level might not even hold. Okay, I've mapped this support level here because you can see through there it's act as a very strong resistive containment line. What I'll do is I'll see if this trade, I'll leave it open and I'll see if we'll see how price reacts to this support level. If I get any strong bullish signals here, then we'll consider exiting. But I'm actually, going on a hunch that this support level is not going to hold, and we're going to see, a break through there again, and we'll get some more reward on this trade. If price starts trading in this area again, we can hold the trade for a bit longer term. Now I've entered with the retracement entry. Okay, I won't go through all that in this video here, but basically in the war room we use retracement entries to get a better price on the setup, and it's already been triggered today from an Asian session retracement, and I've just placed my stop above that high there, added a bit there extra to account for the spread, and now this trade's in full play now, so we're triggered in, and I'll leave the video there and we'll see how this trade turns out, and I'll turn the video back on and keep you guys updated. So yeah, I've exited the trade. Basically, as anticipated, there was quite an aggressive sell-off back to the mean. I'm pretty sure I did mention prior to this part of the video that the mean reversion trades can be quite aggressive. I didn't expect it to be this aggressive though, but nevertheless that's what we want to see. Now minimum target I usually aim for is 1 to 3, so using the retracement entry we pretty much easily got 1 to 3 the next trading day, which is great. However, just due to this large power candle, bearish power candle here closing right on this support level that we were watching, I thought, well, no signs of bullish price action yet, so I'll hold the trade and see how far down it dives underneath the support level. But I just sat down, opened the chart, sat down, had a look at the situation towards the London close on today, which is Friday, and I just noticed that the lower prices were starting to get rejected quite heavily, and at the time I was at about 1 to 4, so I just quit while I was ahead and took profit at 1 to 4. So I'm pretty happy with that, and this is just a great example of how effective price action trading can be. We don't need to use any indicators. We've got two exponential moving averages on the chart at the moment. That's basically just to map out the mean value. As you can see how useful it is helping identify these mean reversion trades. But other than that, the only indicator we really need to use is price itself. It provides enough data and enough insight to what the market's going to do. You can anticipate movements like this with the candlesticks themselves. So yeah, this was great trade. This is why we love price action trading. Very simple. I didn't really need to be involved with this trade very much. It took me about 10 minutes out of my time, and I've pretty much got 400% return on my initial investment. So who's going to argue with them sort of results? If you're interested in any more information on price action trading, feel free to check out our blog. We've got heaps of information there, trade examples, we've got other videos and articles and things like that. So plenty for you to look at there. Until next time, cheers to your trading success. I hope you do well. See you in the next video.